Hello. In this video, we'll be going through finance leases and sales type leases that are made without a profit. A lease is a contractual arrangement between the lessor, which is the owner, and the lessee, which is the user. And the lessor, the owner, gives the lessee the right to use an asset, such as if you're leasing a car or an apartment. The lessor is the owner and you are the lessee using that car or apartment. And in exchange, the lessee provides periodic cash payments to the owner, the lessor. There are two types of leases in accounting. There's a finance lease and an operating lease. And for the lessee, there's the finance and operating. The lessor, when there's a finance lease, the lessor has a sales type lease or an operating lease. The sales type lease, just like if you were to make a sale, you can make a sale with a profit and you can make a sale without a profit. Where the sales type lease is the same thing. You can have two different scenarios with the sales type lease. How do you determine if a lease falls under a finance lease or an operating lease, because the accounting for them are different? There are 5 criteria that are listed here, and if a company meets, if an agreement or a contract meets one of these 5 criteria, then they fall under the finance lease category. If they do not meet any of these criteria, then they're automatically classified as an operating lease. There is a video for these going through these 5 criteria in detail, so I'm just going to go through them very quickly right now. But the first one, if the contract agreement specifies that the ownership of the asset transfers to the lessee, then it's a finance lease. If there's a bargain purchase option where there's an option to purchase the asset at the end of the lease at a bargain price such that it's almost certain that the lessee will exercise that, then it'll be classified as the finance lease. If the term lease is for major part of the remaining economic life of the underlying asset, and major part is 75% or longer, then it's a finance lease. Or if the present value of the total of the lease payments equals or exceeds substantially all of the fair value of the asset, and substantially all is 90% or more, then it's a finance lease. Or if the asset has no other alternative use because it's so specialized in nature, then it's also a finance lease. Keep in mind, finance leases, they try to capture the essence of what is happening in the lease, and the finance lease accounts for the asset lease more like a sale, because when you look at the underlying characteristics of what is going on, it's more of a sale rather than a lease. Okay, let's take an example. Now, because it's more like a sale than a lease, even though it is a lease, you can have one where there's no selling profit and one where there is. This video is all about a finance lease where there's no selling profit. I should say the sales type lease. So the finance lease is what the lessee has, and the sales type lease is the lessor. The lessor is the owner. So if they quote leased an asset that's more like a sale, then they could have a profit or no profit. So this video is about if they leased this asset with no selling profit. On January 1, 2027, Sans Serif Publishers leased printing equipment from First Lease Corp. First Lease Corp purchased the equipment from CompuDeck Corporation at a cost of $479,000. The lease agreement specifies 6 annual payments of $100,000 beginning January 1, 2027, which is the beginning of the lease, and on each year end thereafter for 5 years. The 6-year lease term is ending December 31, 2032, and the 6 years is equal to the estimated useful life of the equipment, which means that it's already going to be a finance lease because the lease term is more than 75% of the estimated useful life of the equipment. It's the same. First Lease Corp routinely acquires electronic equipment for lease to other firms, and the interest rate in these financing contracts is 10%. So first, what we do when we are going to account for a lease and we've determined it's a finance lease, we're going to look at the present value of the lease payments. We're told that the lease payments are $100,000 and that it's for 6 annual payments and the interest rate is 10. So when you look at the present value of an annuity due, you're going to use n equals 6 because it's for 6 annual payments and interest is 10%, and that factor is 4.79079. And so then the present value of the asset that's being leased is $479,079. If you're not familiar with how to calculate this present value of an annuity due, you need to go back and look at videos, 3 specific videos: the present value of a dollar, present value of an ordinary annuity, and present value of annuity due. Okay, because these terms will keep coming up throughout the chapter. So what is the lessee, right? The entity that's leasing the asset, they're going to record this entry in the beginning of the lease. They're going to debit this account called right of use asset, and it's the present value of the lease payments. This is the balance sheet. And the reason for this is because it's more like a sale, so it's more like a purchase for the lessee. And when you buy an asset, you would capitalize that asset onto your balance sheet. So right of use asset, $479,000, and we have a liability because we owe those payments for $479,000. So we're going to credit lease payable. First Lease Corp is the lessor. They now have a lease receivable, right, for equal to the present value of lease payments, and they're going to actually take this asset off their books just as if they sold it at their carrying amount. So this is the lessor's cost or their carrying amount, right? Because in this situation, the equipment was not depreciated, but it could be that the equipment was depreciated and we would credit it at its carrying amount, not its full cost. Problem tells us that there's 6 lease payments, right? There's 6 payments, and the first one is made on 1/1/27. That's how we know it's an annuity due. Because the first payment was made on the first day of the lease. So, first day of the lease that they enter the lease, the lessee debits their lease payable for $100,000 and credits cash for that payment, and the lessor will debit the $100,000 cash and credit their lease receivable. Please keep in mind when you're recording the initial journal entry for the lease payable and the lease receivable, you do not take into account any payments made, even if it's on the same day. You record it for the full present value of the lease payments, and then you will have separate entries for the payment, reducing the lease payable and lease receivable for the lessee and lessor, respectively. Now, the payments are $100,000, right? There's 6 payments. This amortization schedule should look pretty familiar because we learned about it in the last chapter under the effective interest method when we're discounting and when we have a discount premium of bonds. But you're going to take your carrying value or your outstanding balance, it's this interchangeable terminology, and we're going to start with a $479,000 on 1/1/27. That's the present value of the lease payments. And on 1/1/27, there's also a payment of $100,000 on the same day. And so we're going to reduce our carrying value to $379,079, all happening on January 1. Let's see what happens on the second payment date, which is December 31, 2027. Again, another $100,000 payment, but we're going to split that payment. Part of this payment is going to be interest, and the other one is going to be a decrease in the balance, whether it's lease payable or lease receivable. So just like we did with the effective interest method, we're going to take our beginning carrying value, right, which is right here, because nothing's happened between 1/1/27 and 12/31 after that initial $100,000 payment. So, oops, can't see that. We're going to take the 379,000 times the interest rate, the effective interest rate we're given. In this situation, we were told that the interest rate was 10%. Remember, that's an annual rate. And right here in this example, we have annual payments. If the payments were semi-annual, we would have to split this into two and use 5%. But this payment is once a year. So we're going to take the 10% times our beginning carrying value at 12/31, and that gives us $37,908. That's going to be our interest expense and interest revenue component, depending if you're the lessee or lessor. And now the difference between the payment, the $100,000 less the $37,000, this amount is going to be the reduction in your lease payable or receivable. We're going to go through all those journal entries, but first let's just point out that when we look at if we go through the whole amortization schedule, you'll see that the total payments is $600,000 because we have 6 payments of $100,000, and the total decrease in balance is going to be what the present value of those lease payments were, right? That $479,000. The difference is the interest that was paid and earned throughout the term of the lease. So for the lessee on December 31, they paid out $100,000, so they're going to credit cash $100,000. They're going to debit this interest expense for $37,908. If we go back up, that's this number right here. That's interest expense. And they're going to reduce their lease payable by the $62,092 right here. The lessor is going to have a flip, quite the opposite journal entry. They're going to debit cash for $100,000. They're going to credit interest revenue because that's what they're earning for the $37,908. And they will be crediting lease receivable for the difference of $62,092. Okay. Let's do a concept check. Not worth getting consulting leased machinery from Red Inc. on July 1. The lease was recorded as a finance lease. The present value of the lease payment discounted at 10% was $40.5 million. So the present value of the lease payments, they're already telling us is $40.5 million. Is 40.5. Okay. Now it tells 10 annual lease payments of $6 million are due on each July 1, beginning with July 1, 2027, which is when the lease started. What amount of interest expense from the lease should not worth getting report in its December 31 income statement? I like to do my own little amortization chart. I'm going to start with a carrying value or outstanding balance, whatever you want to call it, 40.5 million. And that's going to be on 7/1/27. And then we're also told on 7/1/27 there was a payment of $6 million. And actually, I'm going to erase this just so I have more space. And actually, I'm going to put in the headings for this amortization schedule. The cash payment, I have the interest expense component because we are the lessee, and the reduction in the lease payable component. So on July 1, there was a $6 million payment. There's zero interest expense because it's made on the first day of the lease. So the full $6 million is a reduction of the lease payment, of the lease payable. So our carrying value, our outstanding balance is $34.5 million. Then we go to 12/31/27. There's another $6 million, right, payment. But now 6 months have lapsed and there's an interest expense component. So this $6 million, a portion is interest expense and a portion is going to be a reduction to the lease payable. How do we calculate that interest expense component? Well, we're going to take our beginning carrying value of $34.5 million times the effective interest rate that we use to discount these payments, which we're told is an annual rate of 10%. However, that's an annual rate, and this is a semi-annual lease. The lease payments are made twice a year. So the lease payments are made every 6 out of 12 months, right? And that is going to give us how much interest expense that we're going to recognize over the life of this lease, which is $1.1725 million. Now, going back to our original journal entry that we recorded at the beginning of the lease, as the lessee, we debit a right of use asset for the $479,000 and credit a lease payable. We just saw before that concept check how we're going to reduce that lease payable. Now we're going to do how do we amortize down the right of use asset, right? Because over the life of the lease, the lessee, at the end of the life of the lease, this lease payable will be zero. But at the end of the life of the lease, this right of use asset, this asset should also be zero, because either we're going to hand it back to the owner or to the lessor, or there's going to be some sort of bargain purchase, in which case we would capitalize it at the bargain purchase price. So let's see. So what we do for the right of use asset is we have to amortize it over the life of the lease. And the way we do that is we use the straight line method. We take the right of use asset of $479,000, and it's a 6-year lease, so we divide by 6, and we debit amortization expense, $79,847, and credit the right of use asset for $79,847. I do want to point out that when we're talking about the finance lease, for the lessee here, the lessee will have a component of interest expense and amortization expense. The lessor, when you have, it's going to be called a sales type lease, will have interest revenue. They do not have any sort of amortization revenue. So it's only the lessee will have two components to their income statement. And that'll become more important when we go over operating lease. It's important to remember that for the finance lease, you record interest expense and amortization expense separately.